Having grown up around a family of entrepreneurs, the entrepreneurial life he built one on a foundation of meaningful relationships with purpose and value. That's what drives Fred. So after helping over 500 families, 500, that's a lot, over 500 families with real estate and mortgage transactions, he deploys his expert experience to help his clients correctly navigate from rehabs to multifamily transactions. It's that genuine, dependable experience within the real estate industry that sets Fred apart from with his clients. So Fred finds a balance in life by spending quality time with friends and family, and thrives with the keys in his hand saying, "I'm your realtor. Welcome home." What would he say to a 5-year-old if they asked what the purpose of life was? He'd say to become the best version of yourself so that you can meaningfully contribute to making the world a better place. Could not agree with you more. Love mission-driven statements. Welcome, Fred, to the stage. Please turn your camera and microphone on. We're excited to hear from you.
Hey.
Hi, Fred. Good morning. How's it
Good to see
going?
you.
Look at
Good.
that
Thanks for
hair,
having
looking
me.
snazzy this morning. I like it.
Yeah,
Everybody say
yeah.
what's up for Fred, looking fantastic this morning. Great.
Well,
All right. I love it. How are you doing? Good?
I'm doing great, and it's nice to hear everybody talk. Just excited to be here, so thank you for having me.
Oh, absolutely. We're like so super pleased to have you. So that we're gonna dive in. Fred has a fantastic topic, guys. Multifamily millions. Wow. So Fred, what is the strategy behind investing in multifamily properties?
Okay, so, very simply, I think multifamily properties are often used as a pure investment by collecting rent and for future appreciation. So it can be used as a combination of like a primary residence where you live in one unit and you rent out the other ones. And typically speaking, the cost per unit and the cost per square foot of a multifamily unit is going to be quite a bit lower compared to a single family home in the same area. So because your cost basis is lower, that usually means that you're going to get a better return on investment. So also another thing to think about is from a maintenance perspective, it's easier to maintain one roof of a 4-unit building than maintaining 4 separate roofs of four single family homes. So you can extrapolate that across all major systems and components of a house. So minimizing your cost basis and lowering your overall like ongoing expenses, it leads to a prime opportunity to invest.
I'm here. I wanted to make sure that I let you answer properly. So fantastic. Well, Fred, understand that the cap rate is pretty low in the Bay Area. So why would anyone purchase here?
Yep. Lower cap rates is okay because, when you're looking at real estate investments in general, there's typically going to be 3 major considerations of how your asset is performing. So you have cash flow, you have appreciation potential, and then you have a storage of value. So in general, the dynamic between these 3 variables have an inverse and sometimes complementary relationship with one another. So San Francisco, for example, specifically is known for low cash flow, which means low cap rates. But on the other hand, San Francisco has very strong appreciation. And even during the most turbulent times, it has prices that hold relatively firm, which makes it have a wonderful storage of value for investors that don't have the tolerance for that extreme swing kind of situation. So although the cap rates may suffer a little bit, the long-term potential of appreciation and stability, make this overall a very attractive investment. And to further drive home the point, if you think about the previous peaks of like the housing crash in 2008, from 2008 down to 2012, yep. If we look at some of the fringe areas of the Bay Area, for example, like Pittsburgh and Vallejo, we had properties that had property value declines of almost 75%. So homes that were selling for like, $400,000 in 2008 were selling for closer to maybe $100,000 in 2012. But if you look at San Francisco during that same period, average home was maybe about $1 million. And at that point, even at the worst of it, during that same time period, it dropped to maybe only $750,000. And then now if you look in hindsight, fast forward to today, looking at Vallejo and Pittsburgh, they barely crossed the threshold of 2008 prices. But looking at San Francisco, we're multiples beyond the 2008 prices. So if you look at the overall consideration and look just beyond the cap rate and look at, the totality of the investment,
Right.
depending on your goals, timing, expectations of long and short-term returns, multifamily properties specifically in San Francisco can perform very well overall, regardless of those lower cap rates.
Wow. You guys, it was already worth the wait, right, for this information. Awesome. Fantastic. So with the vacancy rate higher than normal, would you recommend purchasing multifamily properties right now, Fred?
I would. I would suggest purchasing multifamily properties right now because it's very similar to what Sunny was saying, specifically to San Francisco, which is San Francisco is a very resilient city, and it's always found a way to bounce back from adversity. So from the days of like the gold rush to multiple earthquakes to the bust of the dot-com days, the mortgage crisis of 2008, the city's always adapted and remained like a very highly desirable area to live. So although COVID has lasting impacts, probably, it can't take away things like the charm, the geography, the culture of San Francisco. So even though there's an exodus happening right now, I work with buyers every day. There's still a very good demand. So I'll tell you that those that are committed to the city now, I do believe that when people come back to San Francisco, people will come back to San Francisco and those vacancy rates will go down.
I love it. And I also love how knowledgeable you are about the area in general. That's fantastic, Fred. Do you foresee vacancy rates decreasing to a level similar to pre-COVID times?
So that's a tricky question. I always answer these type of questions with a disclaimer, which is nobody can predict the future, right? With certainty. So, at the core, I see this question as one of supply and demand, specifically of the San Francisco market. So right now, supply is relatively high compared to previous times because many residents have relocated to what they believe to be greener pastures. But like I stated earlier, I do believe San Francisco is very resilient and it has a lot to offer. So it's an amazing place to live. The weather, the blend of the urban environment with nature, we're surrounded by water. The culture is amazing. Food options are second to none. So I think once people start remembering these things and we start going back to normal, vacancy rates will start decreasing again. Because I really don't believe that the uniqueness of the city can be replicated anywhere else. So if anything, odds are in our favor that people recognize that this is still one of the best places to live in the world. And then naturally vacancy rates will go back down. And for anybody that has purchased real estate during this time, especially multifamilies, I think those are the ones that are going to benefit the most because once that housing demand comes back, it's nice that you bought in at a better time.
For sure. Oh, wow. I love that. And I also I agree with you. I think it's very resilient as well. So, Fred, when people are purchasing multifamily properties and there are vacant units, do you think it'll affect the appraisal and loan application since lenders understand that it might be difficult to fill up the units?
Oh, okay. So
jumping
this
right
might be a
in.
little
We're
more
jumping right
technical.
in.
Yeah, this might be a little bit more technical of an answer, but
Totally fine.
So what I would say is regardless of the market conditions, having vacant units will likely adversely affect the loan application, right? Because lenders want to make sure of two primary things when qualifying buyers. So the first one is to ensure that the collateral or the subject property is worth what the lender is willing to lend you. So to verify value, the lender will rely on appraisal, and the value is typically established based off of sold comparables in the area. So even if there are vacancies in a multi-unit building, the appraisal itself, when it comes to value, shouldn't be affected. But the thing is that a lot of times the appraisal will include something for a investment property called a Form 1025. And this form is prepared by the appraiser and establishes fair market rent of the subject multi-unit property. So if vacancy rates are high and rents have come down, this could affect how much income the lender would comfortably allow for the rental income qualification portion, which leads into the second thing that the lender will want to know about or to ensure, which is your ability to comfortably pay back what you owe. So in an adverse market, the lender may hedge their position a little bit more by increasing the vacancy rate when they calculate your rents. So as an example, let's say when you purchase a building that's collecting $10,000 in rent a month, a typical rent lender would say, hey, you know what? We're going to build in a 25% vacancy rate when calculating the rental income. So in this case, that would mean that you would be getting $7,500 in credit because that 25% they're taking away, just in case the vacancy rate or whatever may come up. But in a more adverse market, they might want to hedge a little bit more. And they might say, you know what, we're going to up our vacancy rate to 30%. So which would adjust that same scenario down to $7,000 a month in rent for their calculation purposes. So in essence, as the lender tightens up on their underwriting, it makes it slightly harder to qualify for the borrower, because now the difference of that $500 from 7,500 to 7,000, of the higher vacancy rate means that you have less rent going towards your monthly income. So it does slightly affect, and it does make it slightly harder for you to qualify, but not a lot harder.
Okay.
And then it's also worth pointing out that, each bank has its own products and guidelines.
Right.
So one bank might up their vacancy rate to 30%. Another one might still be on the old system and remain at 25% because they're a little bit more risk tolerant. So in the end, just remember that banks are looking to lend money to make money. So they will make adjustments to their products, but not so extreme to a point where they would deny a loan to a good income producing property.
That makes perfect sense. And that'll lead us to our last and final question for you, Fred. You kind of started touching on it. Are there ways to make a multifamily building more rentable? Like, Wi-Fi or free Wi-Fi or a manicured backyard, etc.
Yeah, I think just like anything else, the more value you bring to the table, the more desirable your rentals are going to be. The bare bones of any multi-unit is providing a clean space, comfortable space, maintain the building well. And then any additional amenities, I personally consider the bells and whistles would be, nice things such as washer and dryer, a nice common area space, including partial utilities or including all the utilities in the rent. But a fair warning is I would be very selective about which bells and whistles I would include, only because you're kind of like walking a fine line between the nice to haves and cutting into your bottom line.
Right. Makes perfect sense. Well, Fred, you just did such a fantastic job wrapping that all up for us in a nice little bow. Is there anything you want to share with us before we go into our next speaker?
No, I'll just say, hey, you know what? Just like Ashley said, there are a lot of issues and kind of red tape, so to speak, that you have to get around in San Francisco when it comes to multifamilies. But don't be afraid of that, because a lot of people talk about tenant rights. Remember, landlords also have rights. So if you're able to expertly navigate through that, there's a lot of great opportunities here as well.
Love it. And I love the fact that you're leaving us with that nugget. So we really appreciate and value all of your time. I don't see any questions for you in the Q&A, which is fantastic. Perry says, thanks for all of the information and the clear explanation. So good stuff.